ASML stock is down close to 20% over the past year, and the stock is, in my opinion, extremely undervalued right now. I forecasted 10 years of future revenue and free cash flow, and my fair value estimate lands at over $1,200 per share. And that's over 40% discount versus where it trades today. This also implies a 16% annual compounded return that we as investors could expect from the stock. I'm also giving the stock a buy recommendation and 4.5 out of 5 stars as my final rating. But why does one of the most critical companies in the world trade at such a steep discount? I'll break it down across 4 key sections, starting with what ASML actually does as a company, and then showing the historical financial data, ending with a bull and bear case valuation and a quick technical analysis as well. And let's start off by looking at a quick company snapshot of ASML over the past year. We can see that revenue and EBITDA is upright. We can see a healthy EBITDA margin of 36%, and the share price has indeed gone down by almost 20% over the past year. The company is European, headquartered in the Netherlands, and the CEO is quite new to the job, having started in 2024. So ASML is, you could say, the backbone of modern computing, and most people don't even know it. They are the only company in the world that produces EUV lithography machines, the critical tools used to manufacture the most advanced semiconductors in the world. Without ASML, chips from Apple, Nvidia and AMD simply can't exist. With AI demand soaring, ASML's role is more crucial than ever, and yet ASML stock is down over 30% from its 2024 highs. So the question then is this a generational buy, or could it be a value trap hiding behind cutting-edge technology? Well, in my opinion, the bull case is quite clear. We have monopoly over EUV tech, no serious competitor in sight. ASML has near total control of the most advanced lithography market. We also have, of course, the AI and data boom, right? We have exploding chip demand, which means exploding demand for ASML's machines. And we also have long-term contracts. Strong order backlog provides revenue visibility even in downturns. But there are, of course, a few things to consider if you think about the bear case as well. We have geopolitical headwinds. We have US-China chip tensions, which could restrict growth in key Asian markets where they got over a third of their total revenue. We also have high customer concentration. Top buyers like TSMC, Intel and Samsung drive the majority of the revenue. So now we have a sense of what ASML actually does as a company and the bull and bear case scenarios as well. Let's move on to the second part and look at some historical financial data to see how the company has performed in the past. We'll start off with the core financial performance of the company, where we can see the revenue in blue and the EBITDA in green. And we can see that the growth has been quite consistent. However, we can see in 2022 a slight dip right in revenue and in EBITDA, but then it quickly recovered right the next year and in 2024. We can see that the average revenue growth has been 18%, which is quite strong, and the EBITDA growth has been slightly higher at 21% per year on average, showing us that the company is becoming slightly more profitable. Also, when I invest and look at companies to add to my portfolio, I want to measure the risk of debt within that company. And here we can see the debt sustainability of ASML. We can see the excess cash in green and we can see the total debt in purple. And this is great to see, right? We can see the excess cash is growing nicely at 19% per year and the debt is growing at -4% per year, right? So it's declining. And that is also reflected in the debt to EBITDA ratio, the ratio that shows us how much EBITDA we need to pay down debt minus any excess cash. And that is of course 0 times, showing us that that is pretty much no risk right now within the company. As we later on will forecast the future free cash flows of the company, let's also look at how the company has performed on a free cash flow basis. Here again we can see the revenue in blue, and instead of the EBITDA we can see the free cash flow to equity. So that's the relevant free cash flow to us as equity investors. And in this case the picture isn't as strong. We can see that revenue has grown at 18%, but free cash flow has only grown at 14% per year, slightly below the revenue growth, right? And this partly has to do because ASML is kind of a capital intensive company. They have to invest in their R&D, in capital expenditures for their factories, etc., etc. So free cash flow is not as consistent as maybe EBITDA was, as we saw before. The final chart of data that I have of the company has to do with the share performance of ASML. And here we can see the share performance across 2 dimensions. First, we can see the share price, the average share price per year. Interesting enough is that the number of shares within the company, that's in blue in millions, has declined each year consistently, showing us that the company is buying back stock at on average minus 1.5% per year, showing that investors that own ASML, right, have a bigger share of the company each year by 1.5 on average, and this is great to see. So now we know kind of how the company has performed on a financial basis over the past 5 years. Let's jump to the exciting part, which of course is the stock valuation, and I start off by looking at the key assumptions behind my valuation so you have full transparency on that. And these assumptions go all the way up to 2034, so the next 10 years including 2025. So starting off with revenue growth, I'm assuming 11% revenue growth on average per year in the next 10 years. In the past 5 years we saw 18%, so a slight decrease, right? However, for 2025 I'm assuming 15% and then decelerating the revenue growth in the future. For the EBITDA margin, I'm assuming 38%. That's slightly higher than the 5-year average of 35%, assuming that the company will become slightly more profitable in the coming 10 years. On top of that, I'm also assuming an enterprise value to EBITDA multiple of 20 times versus the 30 times over the past 5 years on average. As the company is slowing down slightly, right, the multiple will compress, right, so staying conservative on that end as well. Let's also look at some of the free cash flow assumptions. I'm assuming 11% free cash flow growth as well for the company in the coming 10 years. And this assumes that free cash flow will grow in line with revenue. We've seen in the past 5 years that it's been slightly below at 14%. So yeah, a kind of an acceleration in free cash flow growth as the company becomes more profitable. Now, on top of that, I'm also assuming a free cash flow yield of 3.8%. That's slightly higher than the 3% we've seen in the past 5 years, assuming that we get more free cash flow on a per share basis as well. And most importantly, I'm assuming a discount rate or a cost of equity as we're looking at the free cash flow to equity of 10.1%, which I think is realistic for this type of company. And here you can see a complete overview of the yearly growth rates I've applied towards ASML for both revenue and free cash flow all the way up to 2034. Now, the important takeaways here are twofold. First, the revenue growth, right? I'm assuming 15% revenue growth as that's in line with the company's guidance. Then the revenue growth will decelerate all the way down to 8% in 2034. Now for free cash flow, it's a bit more complex. The company has in Q1 2025 shown us quite weak free cash flow numbers, indicating that free cash flow growth will be negative for this year. And that's what I've applied in my model. However, I'm assuming that free cash flow growth will re-accelerate in 2026, right? As the company may not need to invest as much in new equipment, R&D, etc., as it's doing right now in this year. And then the free cash flow growth will stay slightly above the revenue growth all the way up to 2031, after which both growth rates will be the same all the way up to 2034. And having used all of those yearly assumptions that we have for ASML, we can also extract a 2034 price target, right? As we have two price targets, one for enterprise value and one for free cash flow. And that gives us a weighted price target of over $1,900 per share. And as I started with in the introduction, all of these assumptions gives us a fair share price of close to $1,300 per share, a implied discount of 42%, and a yearly compounded return of 16% per year using the price target that we just got as well. And this shows us that if we have a company that's growing its revenues 11%, at the same time expanding its profitability, right, we can get above market returns at 16% per year. And with that said, here's a chart that shows us hopefully how this investment will pan out. We have to buy the stock today, right? That's a negative investment for us as investors. Then we get free cash flows distributed to us each year, right? It could be dividends or it could be buybacks, what have you. And then we sell the stock in 2034 at our target price plus any free cash flow we get for that year, right? And we can see the total gains in blue compared to the initial investment, showing us that there is plenty of upside in this company, only assuming 11% revenue growth and 11% free cash flow growth. However, when I look at stocks to buy and add to my personal portfolio using my personal money, I also like to look at the bear case scenario as well, just to see, okay, how bad can this get, right, if the company does not perform at the levels I expect it to do. And here you can see the bull case, right, that I went through throughout the valuation. We can see the discount, we can see the annual return, and we can see the fair share price. But let's look at the bear case scenario as well and see how big is the downside for this stock if it does not perform. So in this case, I'm assuming 6% revenue growth and 6% free cash flow growth. And on top of that, I'm also assuming a slightly lower EBITDA margin. And this shows us that if we have these new assumptions, we get a fair share price of $814. And this is interesting because this is still a discount compared to the current share price of the stock. This also implies an annual return of 7%. And what's really interesting here is that even though the company goes down in growth rate to 6% per year, which is way too conservative in my opinion, we still have some cushioning right now. We can see that the stock is still undervalued and we still get 7% per year. Now that's not great, but that's still not negative, right? We're not losing money on this investment if growth goes down as well. Now, on top of that, I think the company is showing some good technical indicators for us to enter the company as a new position or adding more stock if you already own ASML. We can see that the company is following its long-term trend line, its support line, and we can also see that it's right above its 200-day moving average. And zooming in a bit, here we can see it more clearly, and we can also see that the price is slightly above a historical support level, right? These tend to be support if the stock is above or resistance if the stock is below, right? So entering right now as a new position makes sense, I think, both on a valuation but also on a technical level as well. If you think that the company still has more downside to go and that you'll get a better buying opportunity, here you can see what happens to the annual compounded return of the stock if the stock price goes down. That's in green, that's good for us as investors. Or if the stock goes up, and that's red, that's reducing the annual compound return that we could get. Now, if you'd like 20% or above yearly returns, then the stock has to go down by roughly 20-25%, right, to get down to those levels. Okay, so with that said, let's move on to the final part and go through my detailed rating of the company. And as you saw before, I gave the company a recommendation of buy, and also I gave the company 4.5 out of 5 stars. And here you can see all of my key considerations. We have strong revenue growth, we have strong EBITDA growth, and we have a low debt to EBITDA. In terms of valuation, yeah, we see a high annual compounded return, 16% is higher than the market, and it's well priced, right? The company also has an amazing competitive positioning. However, in terms of low legal and macro risks, there are some risks in terms of AI demand and semiconductor demand being lower than we expect in the coming 10 years. I think long term, this company actually will benefit a lot from AI, even though this is a slight risk. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get the free one-pager, which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.